Hello, everyone. Welcome back to the Wealth Stackers community call. And today I'm going to go over what I see in, having hundreds of people use Stack with over $10 million over almost 2.5 years of the platform. But even years before that, I had a course where I was teaching people to do this, and people still do it by hand. Some people use the app, some people do it by hand. But the overall idea is you could buy and hold, or you can do more with the assets you buy. So today I'm going to just go over all the things that I've seen over the past few years, but I'm going to first start off by breaking down the different ways we all can invest, right? Not just with crypto, but in general, right? So, okay, so I'm going to share. Okay, so first thing is what everybody kind of tells you within crypto and stocks and real estate as well, which is buy and hold and never sell, right? So this is a good and bad thing, right? Because when you buy and hold, your money's basically locked. It's glued away. It's locked away in an area where you can't do anything with it, basically. You have to basically just hope one day it grows, and the perfect time to sell it, or you just wait till that time comes. It could be when you retire, or you have a big purchase to make, and then you just sell the asset, and hopefully it's the right timing when you need to do that, because this is something I've seen many times, and including this week, it happened about 4 or 5 times. I had customers come and reach out and say, "Hey, I need money. I want to borrow from my Stack wallet." But unfortunately, this has been a few weeks of very hard falls, right? This is like one of the biggest crashes in history happened 2, 3 weeks ago now, 2 weeks ago. So wallet values are not up, they're down right now. So it's not a great time to need money at this moment, right? So luckily, Stack, since it protects the value from falling too far, we are protecting that net equity, allowing people to borrow. So there's people borrowing tens of thousands of dollars this week, when if they weren't in Stack, they probably wouldn't have been able to, because if they bought and held, let's say they bought Bitcoin, a lot of people deposit when the prices are the highest. So the last spike in deposits we saw was when Bitcoin was at 126,000. It fell from 126,000 to 104,000. That is a huge drop, over 20% fall. Ethereum went from like 4,800 to like 3,600. Huge, huge falls. So now let's say you had 10,000 and both those fell, let's just say 30%, which both combined, I don't know how the number worked out, but let's say it went down 30%, and you had 10,000 in buffer. So net equity, or no, not even net equity. You just bought $10,000 of Bitcoin Ethereum when Bitcoin was 126,000, Ethereum was 4,800, which is what people did. The price goes down 30%. Now you got $7,000, right? So now if you need $8,000, you don't have it, because the value of the went down. So now we take the second option, which is leverage trading, which is in a way what Stack we are doing, right? Because we take loans against the collateral and borrow more. So when you leverage trade, if the value of your portfolio, if the value of Bitcoin and Ethereum goes down 20%, depending on how much leverage you have, it goes down even more. So with Stack, we do about 3x leverage. So that means if it goes down 20%, your net worth could really go down 60%, 3 times more than just the 20. So that's how people get liquidated, right? So if you're leverage trading, this is what caused the biggest crash in history. A lot of people are leverage trading. They're borrowing off their Bitcoin in centralized exchanges and decentralized, but they don't have that downside protection. So what ends up happening is they put in 10,000, they borrow. And these people do 7, 10x leverage. So let's say they do what they do at Stack, or we do at Stack. 3.5 times leverage. So let's just say 3 times leverage. So they borrow 20 more thousand. Now they got 30,000 with a $10,000 deposit. Now the price drops 20% or 30%. That 30 is 3 times. So that's 90% drop, right? So then all that money, the 30,000 goes down a lot more. So now you end up with that buffer going down. So this is where Stack, we try to protect that as fast as possible because that leverage point, we don't want that to fall. We want to have that money there if you want it when you need it. So leverage trading is not something I do anymore. I started playing around with it, but that's why I built Stack. And this is what caused the largest liquidation in history. And there's still liquidations happening right now. So then we come to what we do here at Stack, which is leverage and sell, right? So what we do is when you deposit, let's say again, you deposit 10,000. With Stack, you borrow 2,500 more or 25,000 more in the 10,000 or 1,000 or 100. It could be any amount. You can put $100, borrow 250. You can put $1,000, borrow 2,500, like that. So let's say we go with the 10,000 number, we borrow 25,000. Now you got about 35,000, but you still got that 10,000 net worth, right? So now as the prices go up and down, and let's say what just happened, the prices started falling. What Stack does is we take some of that collateral and repay the loan to protect the net worth. So what that could mean is your portfolio could be, and I'll show you this here. Your portfolio could be 35K with a 10K loan, creating 25K net, right? So now, I'm sorry, not 25K net. It's 10K net. It's a 25K loan, sorry. Okay, that was wrong. Okay, so it's a 25K loan. And then a 10K net. All right, so now prices fall. That 10K net is based on the 35K going down in value. So if we don't protect that by taking some of that 35K and paying down this 25K loan, you will get what's called liquidated or lose this 10K of net. So our goal is to keep that 10K growing for you. So what we do is we take some of that 35K and we start paying down that 25K debt. So what ends up happening is your overall 35K is going to come down because let's say we take 2K to pay off the loan because the prices are falling. So now you're going to have 33K of net of stack value. And now you'll have a 23K loan. But you still got the 10K net, right? That's the point. So yes, your stack value will shrink, but the real goal here, the reason we're all stacking, the reason we all invest is to grow our net worth, right? So if we allow the prices to fall and take our net worth, especially when we need it the most, which is what's going to happen at the end of a bull run or in situations like that, there's some people that believe that was the end of the bull run. I don't know that. And this is why we do leverage and hold long term and also DCA. So you want a DCA, dollar cost average, meaning bring money in consistently, because we see all the data. I say this a lot, but most people deposit when the prices are the highest, and very few people deposit when the prices are low. The people who deposit when the prices are low make the most money. But again, since crypto is a long-term thing, and there's ups and downs, right? The market goes up, the market goes down. This is how crypto is, right? So if you deposit money here and it's buying here, then it falls, we need to protect that. So you end up with less Bitcoin and Ethereum because we're buying and then the prices are falling and we're still buying. And then we're waiting for this to happen to go back up to take the profits and repay back some of that loan, right? So what I see is the people that bring in money consistently, they also bring in money here because they're not doing it themselves. It's automatically happening. So they deposit money every month. Is $100, $50, $1,000. Different people do different amounts. They're buying more of these lows. So when it goes up, they make more money. Most people who bring in every now and then are, let me try to make this shrink this. Can't do it. Hold on. Oh man. All right. So I guess it's not gonna let me. Oh, there it is. All right, cool. All right. So go back. So buying more at these times because they're dollar cost averaging, they're winning the most. So this is where what we do is we leverage, sell, hold DCA, right? So again, because we know from historical data that most people are depositing money here, we started to protect that downside because before we wouldn't. A few years ago, we wouldn't. And what we realized is most users are depositing at the worst possible time. And then we're dollar cost averaging down, but their health scores are falling and they're not bringing in more money. So we have to end up protecting them and they lose. So now what we do is if that price is falling, we protect the health score. We buy back in at that lower price. But again, seeing what's happening with the people who are dollar cost averaging and bringing in money consistently, like I tell people, I rather instead of you bring in $1,000 in one shot, I rather you bring in $100 over 10 months. Why? Okay, you can't see that. I'm just learning this new system. I'm trying to create ways of showing, not just telling. Um, if over 10 months you bring in $100 every month, you're more likely to catch these lower points. But what we see is people bring in $1,000 right here, and then the price falls on them. And it's no matter the economic level of person. Richest people on the platform do it as much as the poorest people on the platform do it. It's really interesting. I don't know how to solve it. The only way I've seen to solve it is to create the automatic deposits. So that's where the bridge and connecting that dot, where you can connect that from your bank and send money directly every month automatically. We see people doing that and it's working very well. They deposit money every month, automatically it gets deposited into Stack. They don't even have to think about it. So that is the best thing. Okay, so now let's go back to this. So now leverage, hold, and DCA is what we're talking about, right? So you bring your money, you deposit, it borrows, and if prices fall, it repays some of the loan to protect. And then when prices rise, this also happens, right? So if prices rise, let's say you brought in money here and prices were up and then prices drop, right? So then we start dollar cost averaging, meaning we buy every day. Like you see the daily number it buys. Oops. It's not updating. Oh, there it is. Okay. So it dollar cost averages. I guess I should just do it again. So okay, prices are up. Prices are up. People deposit right here. They put in 1K, borrow 2,500 on top. So now they got 3.5K. and the prices start falling. So we're dollar cost averaging, we're buying every day, buying every day, buying every day, buying every day. But the prices are falling as we're buying, so we have to protect. So now we start paying off some of this loan, some of the 3.5K loan because this is the stack value and this is the debt, 2.5K. So now the prices are falling. So as it's falling, we're buying, but we're also having to protect. So now let's say the stack value's 3,100, and we had to pay off, let's say $400 of the loan. So now it's 21 of debt, right? Then the prices come up, but we have all these assets we've been buying at this point. So now, bear with me, I'm trying to learn this new system. So now, let's say we bought, I'm just gonna make up numbers. We bought 0.03 Bitcoin and we bought 0.7 ETH. But our stack value is 3,100 and our debt is 2,100 because we paid off $400 of the loan. So now prices are going up. So these values of this asset is going to go up. So now the stack value grows. And now let's say the stack value is up to 3,200. The loan is 2,100, the debt. So now what we'll do is we'll take part of that $100 and we'll take 80, turn it back into USDC, and we'll take 20 and repay the loan. So now we're going down in loan, right? But the collateral asset is up. And now we dollar cost average again because now the prices are falling again and we're buying it every day again. So this system is what we're doing right now. So what I'm thinking through right now, and this is where I would like anyone watching to give me their feedback wherever you're watching, this is the new thing we're thinking about. Borrow strategically. So going back, and maybe I should just erase a lot of stuff here. Let's see, erase. All right, you know what? Let's just turn it over here. Okay, so let's say you deposit the same $1,000. You deposit the same 1,000, but again, you do it at the peak. Prices are high. So we start dollar cost averaging the 1,000. We don't borrow right away because what we see is everybody's bringing in money when the prices are the highest. So we don't borrow yet. We dollar cost average, let it buy all 1,000. Then there's no health score issue because there's no loan. So you end up with as much assets as possible at this point when the prices are down. Then here we borrow. Stack understands based on the charts, a bunch of different factors, AI, this is a good time to borrow. So here, let's say we were dollar cost average, prices were falling. So now you only have, let's say 700 of Bitcoin and Ethereum because we spent 1,000, but it was falling as we were buying it. And now here you borrow, let's say 1,500. So now we create a wallet of 2,200 stack value and 1,500 of debt loan. So now when prices start going up, this 2,200 is also going up. So now, again, it's maybe better off now because we borrowed at the right time, not at the worst time. So we also have more assets when we borrow. So now we got a $200 gain. And of course, none of this financial advice. This is just stuff we're thinking through. These are all automations that anybody has access to and will be able to choose what they want to do. So we take part of that $200 of gain, and the same thing again. We keep 160 as USDC, and we take 40 and we repay the loan. Automatically, this will happen. So now you end up with less loan, more profit, but we're not borrowing at the worst possible time, which is what I've seen too many people do. Whenever they bring in the money, they bring in big chunks of money at the worst times when the market is going straight up, right? And when the market is going straight up, that's when you want to be selling. You don't want to be buying. But, and I don't know how to fix this. There's been a thing for years at this point. And I know it's part of human nature. All the news and everybody saying, oh, Bitcoin's going up, it's gonna go to 150,000, and everybody thinks it's gonna go from 110 to 150,000 in one day. So they pile in money, hoping that that happens. But actually, what happens is you caught the top, and then the price starts falling. So what we're looking at now is this new idea of strategic borrowing. And it's not ready yet, but we're working on it. And I just wanted to get anybody's feedback and questions, because the overall idea is we're doing this to grow our net worth, and the ultimate goal is to DCA, to bring in money every month to anything, whatever you're going to invest in, even if it's not stacked. And I recommend you figure out how to use your money twice in whatever way is possible. There's real estate, stocks, crypto, life insurance. There's many different ways you can use your money twice. And that's the core of everything we do here, but we're trying to do it within crypto because crypto has a better way. How to get my money out of the old platform into the new platform. Okay, so you can set up a meeting here with me and I will walk you through it because it's not that easy. So the way you would do it is you would close the old one, repay the loan, and take whatever's left, the buffer out. Then you would transfer it to the new system, which is on the Arbitrum blockchain. We have an area that you can do that, or within the app. Then you would borrow again in the new platform and it would do it again. So you can set up a call here whenever time works for you. And if none of those times work, reach out to me in the community and I'll find a time that works for you. Okay. So basically what we're looking at here is we're looking at, can you hear me? Can everybody hear me? Can you hear me? Just want to make sure the audio is good. Hello, hello. All right, I think you hear me. So overall, what we're trying to do is make sure we're taking the most advantage of leverage. And if we bring leverage in the wrong times, then we got to protect on the way down. It still works. We do it and we protect the wallets and it still grows over time. It's just at first, it doesn't work because if you're bringing in money at the worst possible time and then the prices fall. All right, trying to figure out where we are on the screen. Okay. If you bring in money, the market goes like this, right? We all see it. And if most of the time you're bringing in money here with leverage, then we're going to have to protect you on the way down. But if you dollar cost average, there's more likelihood of you bringing in money here. If you just wait for the time you want to deposit money into stack or into investments, period, you're more than likely buying into the FOMO and you're buying into the high points. So two things. This is why dollar cost averaging is so important, because if you're going to bring in a big amount, you're most likely bringing in at the top. So if you're dollar cost averaging, you're buying slower as the prices fall. It's kind of like a way to trick yourself out of buying on the FOMO, right? So that's why we dollar cost average too, because we know most people bring in money when it's the high. So we buy a little bit every day. And what that does is it takes more advantage of the downs. Then when the prices go up, we sell some of that profit and repay some of the loan. Before, when people were just when we didn't have that part where when the prices rise, we sold. We just let it happen and let people bring in more money. But what we saw is people were not bringing in more money. So what was happening is this. And I'll erase. Um, okay. So what we have is there's a loan, right? So if you look at, let's say you brought in 1,000 again, 1K debt. I mean 1K of deposit. Then we borrowed 2,500 of debt, adding up to 3,500, 3,500. So now you have a loan. So this loan is growing with interest over time, but the market is going up and down, up and down, up and down, up and down. So there's points here where we have to protect you because the market is going lower than your loan. So we got to sell to protect. So before we will only sell at these points. And what we realize is most people are bringing in money here. Oops, can't see it. Most people are bringing in money here. So we're only protecting the fall of their value. So what we said is, okay, we have to start protecting higher up in this area. We have to protect their net worth as high up as possible. So what we do now is, as soon as you deposit, we start protecting. So if the prices fall, we will protect. And what protect means is we sell some of the assets to make sure that you don't lose the value you deposited. So now, instead of waiting for these points to protect, we're protecting based on what happens with your portfolio. So it could go up. You might catch a good time when you did put in at right here, and then the prices are growing. So we want to protect that profit that you just made. And I don't know if any of this is making sense visually, but I'm trying to get a way of explaining this stuff in a visual way and not just talking it. So this is my first version of it. So bear with me and let me know if it's helping. Whenever you watch this in the comments or in the community. Okay, so now my pen is dying too. I gotta fix that. So what we want to do now is solve for two things. We want to strategically borrow. The old website is app.stackit.ai. app.stackit.ai. The new website is arb.stackit.ai. We're going to switch it over. We're going to switch the ARB one to the APP one, but there's still some people who haven't moved their wallets, so we're waiting. There's probably like 10, 20 people left out of hundreds. I moved over hundreds of people in the past few months. So okay. Now the idea is if you're not going to DCA and bring in $100 every month, then you bring in 1K at the top. What we want to do is we don't want to borrow in the beginning. We don't want to borrow when you first bring in money. We want to just let it dollar cost average. Then we can, once you've fully bought in, dollar cost average, whatever the price is, up or down, we say, okay, let's wait to a good time to borrow. When the prices are low, there's all kind of trading indicators that let us know that the prices are low. So the AIs will let us know, okay, this is a good time to borrow. And you're either going to allow it, we're going to email you, we're going to set it so you can just automatically, when you see these specific parameters, borrow. So then it will borrow right here. And then as prices are going up, you get most of the benefit from the the growth. Instead of like before, most people bringing in here and watching the fall and us having to protect you on the way all the way down. And by paying off the loan, you're losing stack value because we're paying off your loan. And then when the prices go back up, we take some of that profit, repay the loan, which it does work over time. It's just not a good experience early. And that's what we're learning. So we're trying to, of course, as a company, we've been around a few years now. Our goal is to make people wealthy over time. And if they're constantly bringing money in at the top points, it's going to take you longer. But at least we do the things we do, which is we protect the loan, we dollar cost average. So that's going to bring you up over time no matter what. It's just going to take longer. So our goal is to make it happen as fast as possible. And the way we look at doing that now is the strategic borrowing. And if you dollar cost average with the strategic borrowing, that's a double win because not only are you taking more advantage of the lows because you're buying more assets at the low, you're also strategically borrowing on the way up. So that's what we want, and that's what we're building now. That's the next features we're working on. There's, of course, a lot of other stuff we're working on, but I just wanted to start talking about this and getting feedback as soon as possible. And if there's any questions, let me know. But that's where I'll end this video. Do you have any questions, anybody in the chat? And definitely, if you got questions, put it in the. I'm gonna put this on YouTube and on the community. You could ask questions there later as well if you missed the beginning. I'll stop sharing. But yeah, so that's one of the major things we're figuring out and working towards. But yes, what I've seen in the past few weeks is the app is working amazingly, protecting during our crash, during the biggest crash in history. Stacks wallets were all protected. We had no liquidations. We did sell to protect. We had to. Everybody, if we didn't, most people would have been liquidated. So it worked. And we paid down loan, growing health score. And now people can borrow again. That's another thing I didn't mention, but right now you can borrow more money once your health score grows. So that's another thing that through this new system, you can automatically let it do it. Once it sees a certain level of health score, automatically borrow more money to buy for me at the best time, not when the prices are the highest. So that's where we're going, and looking forward to all the work and back and forth with our team. But yeah, um, thank you if you watched this at any point, whenever. Make sure if you're not part of the community already, go to stackit.ai/community. If you want to learn more about how Stack works, go to stackit.ai/guide. And I'm around everywhere. Ask questions wherever you need to. And Mark, set up a time or DM me in the community and I'll walk you through moving it over. Okay. Have a good rest of your night, everyone, and or whenever you're watching this. And see you back next week.